I'm delighted to announce Enter the Boardroom now has its first sponsor, Alt21, the foreign exchange and hedging platform saving you time and money on your cross-border transactions. As an investor, I was acutely aware of the value of hedging FX exposure. I used to live in fear of funding shortfalls at a closing or making a loss in a business having forecast a profit. However, as a CEO, I'm embarrassed to say I have dropped the ball on FX. Because we invoice our revenue in pound sterling, I stupidly thought we had minimal FX exposure. After speaking with Alt21, I realized a significant proportion of our software costs are in US dollars. So we have wasted money on FX fees and wide spreads, while also taking on unnecessary risk in our budgeting because we assumed the spot rate would continue through the year. I can't be the only one to have slipped up on this, and it's an area board members can quickly add value with the right questions. Alt21 allows you to lock in fixed fees and secure exchange rates before any cross-border transaction, allowing you to budget with certainty and protect your business from market volatility. At NewRoll, we're now forecasting savings of 90% on the fees we incur on the tens of thousands of monthly FX spend thanks to Alt21. Head to alt21.com, that's ALT21.com to find out more. Hello and welcome to Enter the Boardroom with NewRoll. I'm your host, Oliver Cummings, CEO of NewRoll, the board search specialist and market leader, bringing science to the art of board hiring. Today's guest, Dame Alison Carnwath, was until recently Audit Committee Chair at BASF and Zurich Insurance Group, and is Audit Committee Chair at EG Group and at Asda. Ned at PACCAR and Coller Capital, Chair of the Livingbridge Strategic Advisory Board, and Senior Advisor at Evercore. Formerly, she has sat on the boards of many FTSE 100 companies, including Man Group, Gallagher Friends Provident, Barclays, National Power, and Land Securities, where she was chair. Alison, a huge welcome, and thank you so much for joining us.
It's a pleasure.
That is an incredible collection of board roles that you've experienced. Can you just start by giving us an insight into your path into the boardroom?
Yes, sure. I think the most important thing to establish is that I started going onto boards when I was very young. So I was 40, in fact, late 30s when I went on my first board, and 40 when I became chairman of a small cap called Vitec Group. And why was that? They were clients. I was an investment banker in the relationship business, advising boards on their strategy, the financial strategy, on their M&A aspirations. And you become a sort of confidant. As you get more senior in an investment bank, you become a confidant to the CEO and the chairman in terms of the problems they've got on their mind, which they feel they can talk to an investment banker about. That was a lead-in, if you like. I was at Schroders and I was at a small partnership that I joined called the Phoenix Partnership, where we strictly did financial institutions group work and also a little bit of venture capital. And then we sold them to a US investment bank called Donaldson, Lufkin Generate. That took me to New York for 3 years to help them with their sort of international M&A capability. Then DRJ was taken over by Credit Suisse. There's sort of a theme here that is always the case with financial services. Somehow they don't all end up in the right home for long. And so we set up another business called Lexicon Partners. At that stage, I opted out of becoming a full-time operative, became a senior advisor, helped them on their way for 10, 12 years, and then they were taken over by Evercore, where I remain as a senior advisor. I've had these two careers, if you like, moving in parallel, but with the emphasis changing over the years to larger cap companies, and then eventually becoming chairman of a FTSE company. So that's the background, really.
You've since had board roles across a wide range of sectors. Something I struggled with, I used to be an investor director, and I always used to feel a bit of a fraud sitting on the boards of these organizations, having never run a team more than about 5 people and challenging these grizzled CEOs as well as trying to support them. Did you ever find it a challenge moving into new sectors, having had deep expertise in one particular sector only?
Really depends on the company and the sectors. It would be fair to say that years ago when I joined the board of BASF, I knew nothing about the chemical sector. So you rely on the executives to take time and try to explain their business to you. And not that I became an expert in chemistry, but that was one of the more difficult transitions. And also all the board meetings were held in German. I didn't really know the English expressions for chemistry, but I seemed to have learned them first of all in German. And that was probably the biggest challenge. but it was very rewarding. Like all challenges, you sort of somehow master enough, then you feel as though you've learnt and then you can start to contribute. In terms of other businesses, some would say the insurance business is quite a difficult one to understand, but I'd spent an enormous amount of time in advising financial institutions groups, be they asset managers or brokers or insurance companies. I didn't really find that a problem. You find a lot of people who want to perhaps join boards, say, but not financial institutions, and they're wise to avoid them if they know nothing about them, because these are often very fast-moving companies, often highly regulated, and it's, I think, difficult to capture the real problems that these financial institutions can have if you're a board member and just turn up 8 or 9 times a year to board meetings. The other thing, Oliver, which is a little different about my career, is that I did go on overseas boards. Now, that does mean you traveled. I didn't mind that. One of the boards I'm still on is an American board on the West Coast, and Zurich was obviously based in Switzerland, and BASF was obviously based in Germany. So I found that interesting because they all have slightly different sort of arrangements to manage the businesses. Their governance arrangements are all slightly different. Their regulatory environment is slightly different. And I found that very helpful to keep what's going on in the UK in perspective.
You bring to life that journey you talked about at BASF going up the learning curve. For someone listening to this who's perhaps about to go onto a board where they know nothing about the sector and they've got to go through that journey, what was your approach and what were the lessons that you took?
With BASF, I was brought in to chair the Audit Committee. This was because in Germany at that time, which was 2014, they were really behind the UK in terms of the governance arrangements on their boards. And the establishment of an audit committee was quite new. Their previous chairman had been an executive. He had been the former finance director. So he was not an independent board member. So I came in as the first independent board member. And it was pretty clear from day one when he showed me his office, showed me 10 years worth of papers. That was not the approach that was going to have to happen at BASF. We'd got to become more like a normal functioning audit committee as intended by the new governance arrangements. That was the first thing. The second thing is that the Germans do have a 2-tier board system. This means that all meetings were attended by both boards. So it meant there were 19 people in the room. So there's a management board who are responsible for most things. And then there's a supervisory board who have oversight role, but also have what they call a personnel committee, which we would call a remuneration committee, and they have an audit committee. And that supervisory board is made up half by employees who are effectively attached to unions and half by shareholder directors, of which I was one. So the constitution and the framework is very different. So I spent a lot of time first of all, with the investor relations people. They're a very transparent company, so they produce a lot of stuff which is public information. I spent a year shadowing before I actually became a board member. I think that was important. I didn't ask any questions at these meetings, but I was able to see how they operated. I had a finance director who was very patient at explaining to me the business as he saw it through the finance director's eyes. Spent a lot of time with the chairman explaining the history of the business. It was a very large business, BASF. And you just have to find a way of engaging with people so that they can explain. And I'd been on enough boards elsewhere to filter out what I knew was going to be important. Spend a lot of time talking to the auditors in terms of how they operate in Germany. BASF went through some very difficult times. It's a very cyclical industry, the chemical industry. Their 2 major competitors had just merged. This is Dow and DuPont. And they had chosen to invest very large sums of money in China, which some of the investors were a little hesitant about being enthusiastic. So there were a number of really big strategic, almost geostrategic issues that you debated either individually with some of your colleagues, the chairman and the finance director, or you dealt with at board meetings. So it was immensely interesting. To be involved in a substantial German company in this day and age is very interesting. We haven't quite got any companies like that left in the UK, you know?
You talked there about how your experience allowed you to filter out what was important. For someone listening to this who's thinking, gosh, I wish I had a checklist from Dame Alison on what's important, what would be on that checklist?
You know, first and foremost, what springs to mind with me always is what is the financial situation that the company is in. These large companies have huge capital expenditure. They had been on an M&A spree, so they had huge goodwill. They had substantial borrowings, nothing that suggested they were going to be downgraded by the rating agencies. They were spending large sums of money. I wanted to know, from the numbers point of view, were they spending their money wisely? Were the investors happy with payout they got? Was this debated enough? A lot of boards are shy of thinking about what to do with their dividend payments. They're shy about the level of leverage. As we all know, the UK has become an extremely risk-averse place for companies to try to thrive in. So I look at it through a finance person's eyes, which I'm sure you can expect. And the next place I go is the sort of human capital side. Are they really progressive in terms of how they deal with their employees? Do they train them? Do they have focus groups? Do they include them? Do they hire and fire them? Do they make people accountable? Is there a sort of rigorous culture in there, which is not harsh, but is nevertheless important, that they don't tolerate passengers? So I look at it from the financial capital side, and then I look at it from the human capital side. You see then how that aligns with what the investors' expectations are, because my job, after all, at the end of the day, is to provide a view that the investors feel they've got the right people looking after the sort of governance of this board. You look at feedback from the investors, you require to see the meeting notes of investors. You look at the activity of investors. Are there any activists? Are there any hedges getting in there? You assess whether the CEO seems to be doing the sort of job the CEO should be doing, whether the chairman's doing a similar sort of thing. Those are the filters that I look through. What I don't do is decide whether their R&D is indeed examining the different ways that they can contribute towards the growth of an economy, which the chemical industry is fundamental to almost everything we eat, drink and smell. And we're not always aware that almost everything we touch has been touched by the chemical industry first. I learned what was relevant and what they were talking about and what the competitors were doing, and when they felt that they had underperformed or were outperforming on innovation and creation. But I couldn't really add a lot of experience to that because I'd never sat on a chemical company board before.
You talked there about whether they were letting people go and performance managing people. Would you ask for the data to say how many people have you let go for performance management reasons, as opposed to if they left you, and they split that out?
Yes, they do.
Voluntary leavers versus forced leavers.
And this is a very touchy subject in Germany, and you've got the unions on the board. They have a dual role to protect their employees as within the framework of the business, obviously having to succeed. But yeah, I think good companies these days do show voluntary and involuntary. Most companies these days have a permanent sort of reorganization or rationalization program, because the type of people who are running any business these days are very different from the type of people. The skill sets are different. So you want to make sure that you're not just holding on to people who've been with you for 30 years because they're loyal and trusted, and that isn't enough these days. It's important that people are trusted, but it isn't enough. They need to have the opportunity to get retrained, or they need to be let go if they didn't want to do that. So I think that's very important.
Are there particular magic ratios you're looking for, data points? Then there's some leaders who famously said that they're expecting to see 10% out every year.
I'd have to listen hard. Sometimes these comments are made for the purpose of external investors' queries. Every company I've sat on has a different way of dealing with these things. There are some similarities, obviously, but it's just, will they take the tough decisions? Sometimes CEOs sit in that job for 4 or 5 years and then stop taking the tough decisions.
You talked about the dynamics of the German supervisory board and this enormous collection of 19 board members. All the research I've seen suggests that once you go above 6 board members, boards become pretty dysfunctional. But at the same time, there is an appeal in the rationale of having separate entities responsible for, one for the monitoring function, checking the executive have not got their hand in the till, and the other for the advisory and decision-making and problem-solving elements of a board. We've had past guests. Roger Martin famously completely rejected the value of the monitoring function, said execs will always be able to pull the wool over the board's eyes if they want to. Where do you stand on this, having seen UK, US, German board structures? What do you think is the right structure?
It is a balance, okay, and to a certain extent it depends on the personalities and it depends on the cycle that a business is at. If businesses are on an upturn, doing well, then and have governance which is recognizable, then you can spend more time talking about growth and the operations. If businesses are going through a tough time, then you're going to question how they're coping with this. And that's when the hard questions come to the executives. And that's when wool can certainly be pulled over your eyes. But you get an instant for this. You're making evaluations of people's levels of transparency and evaluation of how helpful they want to be. Some new executive board members are very nervous about telling board members anything. You get an instant for this. And then you go and pick the guys who are going to tell you the truth. And that's one of the things I've always tried to establish at an audit committee. It's got to be a much smaller group of people. The audit committee at BASF was tiny. There were 4 of those 19 directors sat on the audit committee, or were part of the audit committee. The CFO on his own, not with a legion of people coming by his side the whole time. And then 3 independent directors from the supervisory board. And that was perfect because we were fed a lot of information. Everybody could ask questions. Everybody got answers. The papers were prepared to my liking. So they gave a lot of detail for people who wanted to see that detail. It's horses for courses. Some audit committee meetings, like the BP audit committee, had about 20 people in it because they brought a whole league of non-participating executives of a senior level. But they were there just in case that question came from one of the board members that the CFO couldn't answer. So it's very varied. I think I've probably gone off-piste slightly here, but is that helpful?
Yeah, I suppose if you had your own business, is there a particular board structure you would want for it, or does it just depend on the situation? I
do believe it's important to have a majority of the board members on a UK company who are independent, because otherwise they have no teeth.
Okay.
The experience, and I've sat on a number of private equity businesses, the experience there is that they're some way behind in terms of understanding how boards can be helpful, because the majority of the board are either the shareholders or the executives. And many decisions are shareholder decisions rather than board decisions. So it's completely different. I think what's worked in the UK is getting up to a majority of independence. But you asked me what sort of board I'd pick. I would always pick people with experience. I want people who've seen it all before, who can be articulate, who can be persuasive, who aren't offensive, who have the trust of the management, feels they're really adding some value, painful though it may be to have to go through regular board meetings. So experience, I think, counts for everything.
Over structure. Okay,
yeah.
Really helpful. Can we talk a bit about remuneration committees? Because you've had lots of experience on remuneration committees, and I'd be really interested for someone listening to this who has never been on a Remco, what were your guiding principles for thinking about executive compensation?
I think it's the area where the investors take most interest. Whether they are wise to do that and to be so voluble on this subject is a question of debate. Okay, there are all sorts of comments you can make. These sorts of investors are normally very highly paid people themselves. So I don't quite know how they are able to perhaps make somewhat negative comments about chief executives' pay. I always cringe slightly when I hear that. That's the first thing. It is the area where the investors take most interest. When audit committees started up, I thought the investors would take some interest in that, understanding the controls and processes and the operational risks that a company took. But they've never really taken much notice of audit committees, which I think is surprising. Remuneration, they do get stuck in. Then the industry got almost hijacked in a nice way by the consultants, and the complexities of the remuneration regimes became such that sometimes it was absolutely impossible to figure out how people were being paid and what people were being paid. That was only, some remuneration reports now go to sort of 20 pages in an annual report, and you have to be a real expert to figure out what's going on. My personal view, having been through all of this, is I would scrap them and start again. I really would. I did have a particularly difficult time at Barclays on this, and did then subsequently resign. Let's just deal with that very quickly. It's all been written about, actually. Philip Orgel wrote a very good book about Barclays and Bank That Lives a Little, and he dealt with the remuneration issues in there. There were so many different remuneration schemes in Barclays that the payment going out from employees to employees was never visible to the shareholder. So the shareholders were concentrating on the top guys. And in a year when Barclays share price had really underperformed and their profits had fallen and their relative share price had fallen, there was a consensus amongst the board members that a pretty high remuneration should be paid out to the chief executive. And I didn't believe that. And I didn't think it was necessary. And I thought the level of the debate that was going on lacked integrity. At the end of the day, that is what the investors are expecting, that the remuneration committee makes a judgment which is fair in the context of the performance of the company. Whereas this whole debate can get very disguised by people saying he forwent a bit of bonus last year, or X from JP Morgan is being paid this amount of money and he'll be off to JP Morgan if we're not careful. It's these sorts of arguments which are fair in isolation, but the reality is these guys are paid for performance. And if they haven't delivered performance through a decent share price or a decent dividend and haven't met their own budget, they shouldn't be paid a lot of money. I'm not all about this. I'm not mean. I'm an investment banker myself. I understand that people can and should get paid a lot. I don't believe in any of this stuff about capped bonuses. If they've done well, the business has done well, the investors are happy, I believe they can be paid a lot of money. But it might mean next year they get paid very little.
The press reported you as having approved the bonus and then subsequently reported you as having been against the bonus. So it's clearly quite a complex environment with the media feeding into this as well.
The board had the ability to approve the chief executive's bonus, okay? And the board did approve it. You know, the press does not disclose whether it was a unanimous approval, and it was not unanimous. Subsequent to that, and a lot of shareholders were very angry with me, and the AGM was deeply annoying. Subsequently to that, Barclays, in my view, changed their weights quite a lot, and I was still there whilst that change was taking place. The CEO got such flack from investors about his pay that these all had to be negotiated again anyway. And then that began a sort of series of some reforms at Barclays. I didn't leave for that reason. At the end of the day, I'm afraid if you're in the firing line, you have to put up with it. I left because it was just an all-consuming job. We got the LIBOR so-called scandal going on. We were underperforming. There were all sorts of things going on. And I was the chairman of the committee, and that particular construct at Barclays had more to do than other board members. We used to meet as chairman of the committees to discuss things, left because it was just too time-consuming.
The psychology of having a non-unanimous agreement on something must be quite complex to manage.
Let me give you an example, which is somewhat of a read across, not to do with remuneration, but to do with audit committee stuff in Germany. If the board disagrees with a recommendation that the audit committee makes and overrules the audit committee, that has to be disclosed. The workings of boards are not totally transparent, nor would anybody ever sit on a board if they were totally transparent. But I'm just simply saying that there is no requirement for people to produce a list of what was voted in unanimously or not.
But in terms of your relationship with the other board members, the CEO, can you talk us through what you learned from that?
Actually, I learned that my colleagues were charming about it all. There was nothing aggravating. They understood where I was coming from, but they just chose to agree with the chairman's view, as opposed to the chairman of the remuneration committee, that in this instance, the remuneration that was he, the chief executive, wanted and the chairman thought he should have is what it should be. So there was a genuine disagreement with the arguments on either side. They were all charming and very accomplished board members of Barclays. So we're not dealing with people here who don't know what they're talking about. They just formed a different view.
And had that been the other way around, had you had a chair of a remuneration committee where you disagreed with them, could you imagine overruling them as the chair of the board?
One would hope it wouldn't end up in the boardroom. One would hope that some sort of compromise could be reached. But in this case, there were conversations outside the boardroom and no compromise was reached. But I wouldn't want you to give the impression that this caused a huge row. People respected, the alternative view.
That's really interesting. What do you think it was about the way that the dynamic in the group worked that allowed that to be such a good disagreement, if that makes sense?
Yeah, I think it's probably the personalities of the people in the room and people's respect for other people's ideas and decisions. If you're hearing this for the first time, so to speak, you might expect there to have been some very harsh words, but frankly, there weren't.
Have there been any other difficult remuneration committee decisions that you've been involved with that really stand out? They're
all difficult and they all take so much time. What have I learned? I've learned that I never want to even sit on remuneration committees. I really have. They're all difficult. And you have to say to yourself, surely the framework that it exists in the UK as to how people are paid. It's okay now. Most people can get paid a salary, which has to be somehow market related. The bonus should be uncapped. They should be very generous, but people shouldn't always top out at all. The long-term stuff, I think, is important. I put more into the long-term stuff, I think, to secure the services of a CEO for 8-10 years. I think CEOs suffer from severe fatigue after 5 or 6 years. But the remuneration, it takes so much time. There's so many people involved. You've got the advisors, you've got the HR department, you've got all the side chit-chat that goes on, you've got the sort of philosophy of the chief executive and how he pays the rest of the organization. All that has to be understood and taken into account. Then you've got the point of view of the chief executive himself and what he should get paid. Some are keener to be paid more than others. And that's life. Very time consuming and not very productive use of people's time, I don't think. All done for the investors.
Okay. So for someone listening to this who's thinking, gosh, should I aim for remuneration committees or audit committees? Do I take it that your firm guidance would be head for the audit committee?
Yes, it would. And it's not always a popular decision because people who have not had any training, I mean, I'm a chartered accountant, so I've had some training in all this, but anybody who's been running a business, it's got to be pretty numerate these days. So they shouldn't be afraid of audit committees. You really do. The numbers do tell you a lot of what's going on. Not everything, but a lot. So I would head for the audit committee and not the remuneration committee.
We've had a number of guests recently talking about how they've navigated crises as board members. And as someone with lots of experience, you've faced lots of crises. I'm really interested to hear how you steered, say, Land Securities through the financial crash as a chair.
I think the key is, of course, to ensure that some of these self-inflicted crises don't occur. And if you have a reasonably sophisticated sort of risk department and you have modern, wide-awake executives who are not sleepwalking into a crisis or think that the revenues will turn up and everything will be okay, there are ways in which you should be able to detect whether something is really going to happen. Interest rates going up is another one if you've got a high level of leverage. The financial markets, are they open for private equity secondary transactions and primary transactions? All of this, I think you've got to have a radar on to see whether the company is going to have a difficult time. The audit committee, of course, has to look at going concern. Some warning signals can often happen there. So the important thing is to be able to get behind what could cause a crisis. Sophisticated boards now have crisis management sort of rehearsals and teams. These are very interesting. We used to do this quite a lot at BASF and Zurich. What if? Let's give an example of Zurich. What if there are severe floods in Europe and the US? There are 3 Category 5 hurricanes and there's a pandemic in Asia. And what happens if all that happens within a sort of 24-month period? How is the business going to cope? And we rehearse that and we role play it. So that is a good exercise, in my view, to go through. In Land Securities' case, we had a period where apparently they couldn't find the bottom of the property market. The property market at some stage bottoms out, and transactions in the property market are by definition always historic, and the balance sheet is made up of historic values as opposed to future values or expected values. And although we were not highly leveraged for a property company, it became apparent that if this bottom wasn't found, there was some danger that our operating capability would be restricted by the covenants attaching to our debt. I think the first thing that happened is that the finance director and the chief executive and I decided that what was probably necessary, and because there was money available, we should raise some equity to provide a buffer. Now, obviously, the share prices have been following the property values down, so it was a difficult time to do a rights issue and not necessarily beneficial for those that didn't want to take up their rights, because there'd be a big discount to what was likely to be the property values in a few years' time if the bottom was found. And anyway, the banks to underwrite it would want even more of a discount. But JP Morgan was open for business. Okay, it basically must have taken a decision that it was going to help the property market through this. In fact, most of the listed property companies, not all of them, but most of them did do big rights issues. So the first thing we did was take to the board that we thought we ought to do a rights issue. And this isn't a standard board meeting. This is a board meeting called because the opportunity to raise some money was there. We couldn't foresee when the market was going to stop falling. We didn't want to have any restrictions on our operations. And anyway, if we raised the right amount of money, some of it could be used then to buy back into the property sector at lower values. And as I think would often happen, the board said, no, we don't think this should be done. We had one particular board member who was very vociferous on this, and this meeting was obviously going nowhere and not coming up with, in my mind, or the chief executive's mind, or the finance director's mind, the right decision, because the board was in shock about all of this. So we just let it ride, okay? We just said, look, we don't think we're necessarily reaching the right conclusion here. Let's come back to you with some more stuff. Let's get some bankers in to talk to also about what's going on in the marketplace at the moment. Let's not miss the boat here, because if we do change our minds and go for it, then we've got to have a marketplace which is open. And that's exactly what happened, Oliver. A week later, we all met, and a lot of conversations had taken place with board members, by myself or the chief executive. The sort of stuff that you can best do on a one-on-one rather than round a boardroom table. Nuances of things that people were misunderstanding or hadn't heard correctly, or we hadn't explained properly. And then we did our fundraising. It was actually a small fundraising compared to the other property companies. The chief executive stayed in place. He'd got to fix all this, got to get us out of this mess. It wasn't of his making, this mess. We sold some buildings at the bottom of the market, which wasn't ideal, but that gave us also a bit more cash. And we survived. And they all did. All the property companies survived, except Into, which quite a long time later did fall foul of its covenants. So I think it was the UK stock market working at its best, combined with a realization that the property market is very volatile and does go through some very bad cycles. Has that changed the way Land Securities is run? They remain cautious about leverage, I'm sure. Because it was a market correction that was taking place, it wasn't really a management issue. These were 45% declines in the value of our balance sheet. These were big numbers. If we had always managed, which is what Land Securities was, with no leverage, nobody would ever have invested in us. They like the leverage on the upside.
I'm fascinated to know how you think about that relationship between you yourself as chair, the CEO, I think it was Francis Selway at the time, and the rest of the board, because the way you talk about it there, it sounds like you really had your sleeves rolled up alongside Francis and pretty active with the management of the board and some of those decisions. How do you think of it? What's the framework that you have in your head for your role as chair in that situation?
You step in. If there's a crisis, the chairman does have to roll up sleeves and step in. But I had two executives in terms of the chief executive and the finance director who were not in denial and realised something had got to be done, as did I, and had to take a decision as to whether to go for some equity or not. And we were aligned on this. So we just had to basically work together to continue to persuade our board members that this was the right thing to do. The board was probably right to say no in the first place because they hadn't had the sufficient time for it all to calibrate, and we needed to keep giving them information. But in terms of my role, yes, you step in situations like that, particularly if you have some knowledge of how the markets are operating, which I obviously did from my investment banking days.
There were some fairly seismic shifts there you were dealing with and some quite high-stress moments, I imagine. As a chair, what were your sources of support and challenge?
I talked to one or two of the other board members who I thought would be able to add to the debate, which they could and did. I relied on the management because I trusted them. They were a fairly conservative bunch, but I had no problem with conservatism at this stage of the game. I think it's incredibly important to keep calm. The crisis, describing something as a crisis, does put people's antennae up. It didn't have to be a crisis. We had a solution. We weren't going to go bust or anything like that. But it was a difficult moment for the company. The executives, I think, felt very shameful of it. And there was no point in dwelling on that. This was a practical problem that we had to deal with.
But for you as chair, did you ever work with a coach, or do you have a close group of friends outside the board that you bat ideas around with? Or how do you grapple with some of those issues?
At that stage, this was 2008, I think. At that stage, I think how do I grapple with these issues? Yeah, I do occasionally talk to people, but this was very market sensitive stuff, you know. I'd probably talk to one or two bankers who I was close to, one ex-board member I talked to. In moments like this, most people want to know that the chairman and the chief executive are aligned and have a solution, and that the solution makes sense. We hadn't got months to do all this in. We're talking about a few weeks when we had to make these decisions. I never had a moment's doubt that this is what we had to do. So anybody who wanted to persuade me otherwise had to come over with some different arguments. But the executives were of the same view. This needed to be done. Every situation is difficult. You want to ensure that it's not charged with emotion. You've got the press people ringing up their time. Is or is not Land Securities going to do a rights issue? You mustn't get excited about it. You have to recognise there are a lot of people dealing with this for the first time. This isn't the first time I dealt with a rights issue, albeit it was the first time as the chairman I dealt with a rights issue.
Alison, time has flown by, which means it's time for the lightning round, where I'm going to say a short statement and ask you for a quick response if you're ready.
Okay, all right. Let's see.
Best book every board member should read and why?
Best book every board member should read. Let's come back to that.
Boardroom behaviour that irritates you most.
Dominance by non-execs who don't give other people space to, I really can't tolerate that. Everybody's got to. I want the non-execs to make the chairman's job quite easy. And the chairman is inviting everybody to provide some input. Sometimes you get these dominant board members who just bang on, and I find that really irritating.
Most valuable board ritual?
Ritual? I like board dinners followed by board meetings. I like going to operations. I like giving boards the opportunity to meet the next 2 or 3 layers of management. I like inclusivity is the way to look at it.
Favourite quote?
Every board should have a shit.
Most significant professional insight?
The experience counts.
The worst professional advice you've ever received?
Don't go for that job.
What have you changed your mind on about boards over time?
I think people's expectations of what they can achieve are probably a little bit too high. And I think I would also put into this category that one has to be incredibly careful about this industry called governance. I think a lot of people are put off from UK boards in particular by the governance regime. I do believe in governance, incidentally. I really do. But I think sometimes it's become micromanaging, and I find that annoying.
When was the last time you got a significant judgment call wrong in the boardroom, and what did you learn? I
think I probably got one wrong this year, and you try to justify whether, okay, you shouldn't have gone there. The advice you were giving was not going to be welcome. You should have recognized that. So I think sensitivity to what you can and can't say is important in board meetings. Yeah, sometimes I get that wrong. I'm quite outspoken. Some people find that a little bit overwhelming.
How are you better today as a board member than when you started?
I'm sure I'm not. I've got lots of experience. I've got lots of resources. But I'm the same person. I'm just a bit older, and perhaps I'm a bit wiser because of my experience, but I don't know that I'm a better board member. Maybe one thing, actually, I would say. I think you can become a better board member if you have been a chairman. So I selected not to become chairman of anything after Land Securities, but I selected still to remain on boards. So I think seeing it through the eyes of how a chairman has had to operate, I think is quite valuable as a board member.
Why did you choose not to be a chair after that?
It's more time consuming. I didn't really want to do anything overseas, and I couldn't really see a business in the UK that I thought would be an interesting challenge as chairman.
Finally, 3 things our listeners should take away from this podcast if they take nothing else.
Okay, they should enjoy being on boards. That's absolutely vital. If they're not enjoying it, they shouldn't feel at all hesitant about disappearing. Secondly, look very carefully at your fellow board members, particularly your chairman and your chief executive, for all sorts of reasons. Their tenures might be up. There will be reputations out there in the market in terms of whether this company is performing well, whether its governance works. Do a lot of due diligence. You can do that these days. It's all out there. That's the second thing. And the third thing is don't overstay your welcome. If you're feeling you're not contributing for any reason, don't think you've got to do your 3 years or your 6 years or your 9 years.
Alison, you have oozed wisdom and irreverence, which I've loved. Really. Thank you so much for taking the time to share your experience and wisdom.
Okay.
Building a non-exec career is hard. For those starting out, boards can be opaque. For more experienced board members, it can be lonely and hard to stay match fit. Having placed almost 4,000 people on boards in the last 5 years, we know what success looks like. It requires time, energy, resilience, information, and connections. New Role Plus, our community of board peers, exists to give you these things, offering you wholesale support as you try to get board roles and become a standout Ned. Find out more at newroll.com/newroll-plus. That's newroll.com/newroll-plus.